In part three of our discussion here, we're going to change gears just a wee little bit. What I would like to do is talk about some of the models we've done so far, look at a model that's not in our textbook, but a model that I think provides some interesting insight into how investors may feel about a particular company, and then look at information in general and how that might affect stock prices. So the first part of this then is talk about the comparison of these variation or these multiplier models to the discounted cash flow models. Discounted cash flow models do have an advantage because they incorporate some information about the firm's cost of capital, future growth. It really looks at smaller portions of information from the company, whereas the valuation multiples are a more broad-based kind of a model or a formula, if you will. So the discounted cash flow models do have a potential to be a little bit more accurate, maybe, because we use smaller pieces of information. However, the valuation multiplier models are very simple. They can give us answers fairly quickly about what the public or what the current values of the companies reflect with respect to what a company is really worth. So let's look at another opportunity of analyzing a company. What we want to talk about here is something referred to as growth opportunities. The growth opportunities really look at a company's strategy in its investment process, right? So the value of a company can be conceptualized as the sum of the value of what a firm pays out of its earnings, right? What would it be worth if it paid out everything as dividends, plus the net present value of any of its growth opportunities moving forward. So essentially it looks at two things. It calculates the value of the company as a cash cow, and it also looks at the value of investment opportunities. So the value of a stock is the earnings per share. This is the value as a cash cow. And this is the value that the investment strategy provides moving forward. So let's think about how this might work. So we have a company, has earnings per share of $5, dividend payout ratio is 30%, has a discount rate of 16, and it earns 20% on its investments. So the dividend at the end of year one, again, is going to be 30% of the $5, or it'll be a $1.50 dividend, right? The retention ratio then is 0.7. So if you have a growth rate in dividends, right, then it's 70% multiplied by the growth rate. So the growth rate is roughly 14%. So the value of this stock is next year's dividend divided by, this is just the dividend valuation model. This stock is worth $75. But what we want to talk about is, can we break that down into some parts so we can kind of understand how we as investors feel about this particular company? So for Disney, the way I did this, right, I changed the cost of capital. I changed it. I used the average of the two cost of capitals that were provided in the model. So that's 10.19%. I also used a more reasonable growth rate of 7%. Quite frankly, I did this so that the model would work and we could look at a real company, not TAP. This is Disney, sorry. And then I plugged in earnings per share for next year, which is $5.94. So what the net present value growth opportunity model does is it breaks price down into components. the value of the cash cow, it calculates it. So this company is worth $58.31 if it had a value as a cash cow. Now, if we use the dividend valuation model, it says that of the $96 that it provides for the value, $37.70 comes from future expectations of future net present values. If you look at the stock price, again, remember, stock price is based on what you and I think. We think this stock is worth $110. So what we're saying is that the value of future dividend or future net present value projects is $52. Again, it's relatively a ratio here, almost 50-50%. But you can see here that the company has, if you want to say what do the opinions of shareholders, in this case, I mean, they're probably happy with this company. However, the investment strategy is providing less value to the price than what the value of the company as it's running is. So in other words, investors see more value in what the company is doing right today over what they will produce in the future. Again, they're both positive numbers, so there's no problem. But what do you think would happen if the net present value growth opportunity were negative? That would imply that investors feel that the current investment strategy of the company is really bringing the company down. It's not generating value moving forward. They're doing nothing to the price of the stock. So if that was a company that you were looking at, or if that was a company that you belong to, you really want to take a look at your investment strategy, right? Are you investing in bad things? Are you not communicating well to investors what you're trying to do, right? Or is it a combination of those two things? So again, looking at how this plays out for the company, it gives us some insight into what investors might feel, right? So if we can increase the retention rate of the company, right? In general, thinking about value, right? An increase in retention rate is going to reduce dividends to shareholders. What are we going to do with that increased retention rate, right? We should see an increase in the firm's growth rate. Okay? If these things have offsetting effects, right? If reducing the dividend is exactly offset by the firm's growth rate, what does that mean for the stock price, right? If the return on equity, the return to investors' money, is greater than the return it gets from projects, then increased retention will increase value, right? If you get more from the projects that you do than the cost of doing those projects, the company should see an increase in value. So if you are reducing dividends but providing good projects, we may still see increased value of the company even though dividends are declining. So these, just as a final caveat, I guess, right? No single technique gives us all the answers. There's lots of assumptions. Most real-world practitioners are going to do a variety of these concepts. If you kind of think about the values that we've shown with these techniques, it's a wide range of values that we found. Some of them outrageous, some of them not possible, right? Negative $414. Again, I revised that a little bit, and so we still came out with a value of around $90 to $100 with that revision. But again, the purpose of this is to get a picture of how do companies determine what their stock is really worth. Again, there's a lot of, just so much stuff going on here. Most companies, most financial institutions that are in the business of getting clients to buy stocks, they use a variety of these techniques. They're going to look at a lot of things to make sure they really have a good grip on what is the ballpark value of where the stock should be. So now let's move on to another topic. Now we want to talk about is how does information get into stock prices, right? The valuation models that we talk about link future cash flows, cost of capital, and share price. So how do we get that information? How do we find that stuff? The better information we get about the variables, obviously, the greater our accuracy will be with predicting a third value. We're coming up with the actual value of the stock. So for a publicly traded firm, its current stock price should already provide very accurate information, right? Because obviously there are an aggregated number of investors. There's literally thousands of investors who are evaluating stocks every day and providing insight, providing opinion to value. So they're all producing, if you kind of think about the economics and supply and demand curve, right? The investing public determines the demand curve. As they generally feel good information is being provided, then the demand curve will shift upward, right? So a valuation model is supposed to give us some information about a company's future cash flows or their cost of capital or the required return for that company. We have a theory, or a hypothesis in this case, that's referred to as the efficient market hypothesis. It implies that securities are going to be fairly priced based on their future cash flows, given all the information that's available to shareholders, to investors. So what kind of information do we have? There is public information, right? This is information that's available to everybody, right? News reports, financial statements, announcements, all of those things are readily available to all investors. So we can incorporate that into our analytical thought to come up with our expectations of value. So we expect stock prices to react nearly instantly to all of these types of information that can become to the public. Having said that, then, it's going to be very difficult to achieve higher than average returns using public information. Since everybody has it and the price is incorporated very quickly, it's almost impossible for new investors to buy a stock or trade a stock and ultimately get some kind of value from it using public information. Private information, right, is a different story, right? This is stuff that's only known by a relative small number of investors or people inside a company, right? Efficient markets are not going to hold here, right? As these traders begin to trade, though, they're going to move prices. So over time, prices are going to begin to reflect that information as well, right? So we have a couple of things at work here. Not much information is known by investing public. However, we have investors who know piece of information that not most other people do, or they're insiders that know information that nobody knows. And these people will trade. So as they trade, some of that information is incorporated into the stock price. However, if you're using private information to make trading transactions, you should be able to get higher than average returns, right? If you know who's going to win the race before the race starts and you bet on that person, you should be right every single time, right? So earning these higher rates of return are part of the process here, part of understanding how prices are created. So essentially, there are two prices in the world. There are prices that are determined by you and I, investors. That's the market price. But there's also a value of the stock that is true, sometimes referred to as the fundamental price or the intrinsic value of the company. They're two different things. One we can trade on, one we can't. So if profit opportunities from this private information are large, right? If you can make large profit from trading on inside information, people are going to spend lots of money to try to get that information, right? So in the long run, the efficiency in the market is kind of determined by the cost of information. If information, especially inside information, is very difficult to get or very expensive, people won't use that information because it reduces their overall returns, and the prices that we see will reflect public information more than they will inside information. So when announcements are made, what do you expect to happen to the price of stocks? If the investment has good information, we would expect the stock price to rise to a new level. Now, if there were no other events, if the market were perfectly efficient, once it received this new level, it should be constant. It should be a flat line. However, if the market is not efficient, the price could go down, or it could go up, depending on the influences of this information. So again, what do we expect to happen when stock prices change? We expect the price to change. We typically know the direction of the change. What we don't know is what's going to happen once it gets there. That's ultimately the challenge of investing. So what are the consequences for investors? If stocks are fairly priced, then when you buy stocks, you expect to get the future cash flows that fairly compensate you for the risk of that investor. Again, an average investor can invest with confidence, even if you are not fully informed about all the other aspects of the company. How does this affect the way managers think? Managers should focus on net present value and free cash flow. Don't become distracted by other pieces of information, if you will. Managers should avoid doing accounting things that are referred to as illusions, right? Don't change your accounting methodology to show increased profits, because investors are going to see through that. And in the end, that does absolutely nothing for the value of the company. And in the end, we should be using financial transactions that support the investment. Gather funds that are representative of the risk, the desires of shareholders, etc. We'll talk about this more later on in some other videos when we talk about financing and how managers decide how much money to gather, etc. So that's the end of stock valuation.